Talk about some specific items of gross income now, items that are specifically taxable. The first item we're going to get into here are below market loans. What we're basically talking about here is loans between two parties that really aren't loans because they don't look like loans. They're talking about loans where the interest rate, either there's no interest between the parties or a very low interest rate, which is below what a typical going rate of interest would be. So, nobody, no prudent business people would engage in a loan arrangement that didn't charge adequate interest. So the government basically contends that if you are in an arrangement like this, there must be some other kind of, you know, funky relationship going on that's prompting, the parties to enter into an engagement or a transaction that wouldn't really happen in an arm's length situation. So what they do when you have those kind of loans, and you can read through the definitions there, what they do is they call those kind of loans one of three different types, and they have some rules then for what they call imputing interest on the borrower and the seller, or the borrower and the lender. Basically, what that means is we're going to infer some interest income and some interest expense to these two parties as if it was an arm's length transaction. So gift loans are these quote loans between like family and friends, which it's really not a loan; it's more like a gift, because you like somebody. Compensation related loans are between an employee and an employer. So really, it's not really a loan; it's more like compensation, because that's what an employer would pay an employee. And then corporation to shareholder loans; these are loans, quote loans, between owners and their wholly owned businesses. And in this case, it's not really a loan; you're really just paying dividends from your company to yourself. So these situations will result in these items kind of being inferred or imputed on the participants in the transaction. But there's a whole bunch of like stipulations and rules and regulations, exceptions and limitations down here for there's this $10,000 de minimis exception. There's $100,000 rule. There's limitations on investment income. Basically, I'm not going to bother talking through all this. You read it. You're going to have a homework problem on it, and you're going to have to do your best to kind of sift through the limitations and decide when they apply, and just apply it to the best of your ability. After the due date passes, go back in, see if you got it right, understand the logic that went into answering those questions. The tax benefit rule, learning objective 6. This basic idea, and I'm going to let you just kind of read through this yourself too, but the basic idea is if you take a deduction in 1 year for an amount of money that you spent, and you save some taxes because of that deduction, and then the next year you get that money back, then you have to pick up income in that second year because you got a tax benefit on this basis, on this premise that you paid money in the earlier year. So if you get that money back, the government is going to make you put that amount back on the tax return as income and pay your taxes back. It goes both ways though. So if you recognize income in 1 year on an accrual basis, and you pay tax on that income, and then you end up, not getting paid by that person, that customer, you get to take a deduction in the following year that allows you to deduct from your income and pay less tax, kind of get the tax back that you paid the year before. And to kind of follow that further, if you then do get paid by your customer who didn't pay you before, then you're going to have to pick up that money in income again, because eventually you did get paid. So the benefit rule just follows the idea that if you get a benefit for a deduction, and then you get your money back, then you lose that deduction essentially, and you have to pay some tax. So read through that. There's a homework problem on a few examples of that, and we'll pick it up with the next video.